Hello and welcome to Smart Money. I'm Alishia Seckam. Well, over the past 50 years, Spur Corporation's managed to build up an iconic stable of restaurant brands. And really, that no easy feat, right? Where the headwinds, especially over the last few years, have been pretty strong. Spur says it owes some of its resilience to the fact that it's able to keep a keen eye on the changing needs of its customers and then catering to that. So today I'm catching up with Val Nichas, she's CEO of Spur, about surviving a tough economic climate. Val, thanks so much for joining us today. Great to be with you. And I remember having chatted to you just as you took to the helm of Spur back in 2021 as CEO of Spur Corporation. So before we get into the nitty-gritty of the business, talk us through a bit of your journey in getting to that point and why stepping in just after the COVID impact hit hard seemed like a good idea for you.
Good morning, Alishia. Wonderful to see you too. It was an interesting time. In fact, when Mike Bosman called me, our chairman, we were in the middle of lockdown. And I remember I'd been running my own business for 8 months. And with lockdown, a lot of projects came to a halt or were paused. And he still phoned because I'd known Mike before, not for long. I'd worked for him for a year. And he said, "Are you retired on an island in Greece?" And I said to him, "You got to be kidding. No." And he spoke to me about this opportunity. I think a few months before that, Pierre Fantonda had retired. And that's how the offer came about. So it actually came as a blessing at a time where I was definitely not thinking of going back to corporate. In fact, corporate was over. But the opportunity appealed to me because he said one word, which just resonated with me. He said, "How would you like to be part of transforming Spur Corporation?" And earlier that, it was, I think, 2 weeks before, George Bezos had passed away. And I remember watching his funeral, hearing about the impact he had made in the country with Madiba and how much he had done for him. And I thought, actually, I wouldn't mind doing something that had a lot more purpose in the sort of last part of my career. And so I'm back in corporate. So it happened unexpected, a blessing. It came at the right time. I had the right energy. In fact, I forgot how much I love franchising. So I'd been running my own business before that. And as you know, my career before that was also with the likes of famous brands, Edgar's, Nando's, a few other people.
It's so interesting that you use the word transformative and that the appeal for you at that point, because, there's no denying, Val, that Spur is an iconic brand in South Africa as a headline brand, but also when it comes to the other brands it holds, Panarottis, Rockamama's, John Dory's, the Hussa Grill as well. How do you think it's been able to sustain its brand power and popularity locally over the years?
Yes. Spur is a 56-year-old brand, actually, just turned 56. And it's incredible. I think what has helped the Spur brand survive, and don't underestimate, it's gone through its difficulties, over the years for different reasons. I would say probably because it stayed close to its brand proposition or its value proposition, which is around family dining experiences. Just that differentiator we have of the birthday celebration is so key. And we've kept that focus, but every year try and freshen it, whether it's adapting the song, whether it's looking at the different party packs. So I think we've remained focused on offering that unique experience. And people have tried to copy us, but no one really does it as well as the Spur brand does it. And that's the restaurant team. Kudos goes to them. So I think it's keeping that focus. And I think it's also ensuring that the quality of the product remains best in class in terms of our ribs, the known tastes of the pink sauce, which is so popular, the Durkee sauce, the cheddar mel steak. Those are known properties and have resonated with the consumer. But above all, I think the biggest shift that happened in Spur was it welcomed the mainstream South African consumer 20, 25 years ago into the restaurants to dine with them, a lot of families that probably had never sat down to be served by a waiter. And that's our aim now, is to ensure that we get in the next pipeline of filling that pipeline with the next level or tier of consumers that haven't dined out yet. They're
And
eating
of course,
QSR.
you've got to evolve in order to survive, because it's been a pretty tough operating environment, right? Looking at the last couple of years alone, Val, restaurants have come up against, the COVID pandemic and the resultant lockdowns, load shedding affecting almost every sector in South Africa, high interest rates and rising inflation really pulling purse strings tighter. So how has Spur navigated some of those challenges specifically?
So it has been tough. I remember when I took over, in fact, I took over at the back of a laptop. And I thought, oh my goodness, running an organization in lockdown. So we try not to say that damn C word anymore. But we did obviously have a negative impact through the pandemic, with the restaurants closed for a month, not serving alcohol, sort of shortened trading hours. So it was negative. I mean, we were performing at minus 32% on the previous year. So it was really tough. And as we started recovering, we then had the July unrest in KZN. So we had that impacted as well. So it has been difficult, and we've had to really keep the teams focused, try and leverage things like takeaways at the time, to try and just keep our customers connected with us. So it was tough, but it's over, thank goodness. And I think had the KZN unrest not happened, we probably would have recovered to 2019 figures a lot sooner. So if you look at the trend line, a lot of industries recovered sooner, and we took a little bit of time because of the unrest, and a lot of shops were looted, etc. So that was one way. In terms of the load shedding, that's been an interesting one. We are really grateful that quite a few years ago, the group with the franchise network agreed to install generators, so an investment by our franchisees. So at the time of the peak of load shedding in October last year, we had about 97% of restaurants that already had generators, and we're almost at 100% now. We've got the odd store that's still getting or can't get access because of the malls. So we were quite fortunate to be able to have that. Obviously, it has added to the operating costs of the franchisee to run the diesel, an average of about 1% of expenses, some a lot higher, but at least there's been a net gain. The only thing we've seen in recent months, because load shedding has eased a bit, the consumer, I think, has also got wiser, because we're trying to work out what's happened here. And I think we've all got smarter. We sort of either have geared up our homes with alternative power supply, and if I'm a lower income person, it's probably torches and gas stoves. And if I have more disposable income, it's probably inverters and generators. But I think consumers have also got smarter on how to deal with it. So we definitely saw a huge influx in the beginning of people eating out, because that was just so convenient. Kids can play, moms can, or dads can work while they have a meal. So we've managed to get through it. But I think the infrastructural challenges are continuing in the country, because we've got water now starting to become an issue in some regions.
Yeah, of course, you initially then saw demand at your restaurants rise, right? As consumers opted to eat out or were forced to eat out as a result of load shedding. And that offset some of that increase in the cost base that you mentioned, Val. Now that you're seeing a shift again, is that proving to be a difficult one to manage, your price points that are now set on your menu, because you're catering to a strained consumer that's under economic pressure, but you're having to deal with that uplift on the operating cost front on your end quite a bit?
Yes. So the menu pricing, obviously we always look at food pricing, input prices, and they have gone up. With the Ukraine war, we saw anything that's got oil, including oil, go up. It has settled down a bit, but that did put a pressure on the supply chain, and it continues to be under pressure, as you know, with the avian flu and the shortage of chicken and eggs. What we always try and do with any menu change, and we try and look at menu cycles every season, so every 6 months, we always try and ensure that we've got a value item, an entry-level price point, a better deal, so that for the consumer who can't afford the bigger grills or the bigger plate can still come and enjoy an unreal breakfast or 4 ribs and some chips,
Okay.
4 wings and some chips, so smaller offerings.
Okay, got you. I've got to still ask, how difficult, even with all of this now entrenched, how difficult is it building a franchise network in the current climate? Because as much as you're, talking about adding restaurants over the next year, there have also been closures, in the recent past. So has it become a harder sell to investors looking to venture into the franchise space?
It's a very good question, Alishia, and it's one that challenges us all the time because our business is about franchising. So I think there are two arms. The one is about keeping the brands relevant and appealing to the consumer, because if the brands are successful, the investor can see that he's going to get his return on investment sooner, or at least within 4 to 5 years, which is what we normally want to see. So we've been on quite a big journey to keep Spur fresh. We've rebranded, and we can chat about that separately. Spur, we've repositioned Panarottis. We're on a big project with John Dory's. We've opened 6 new John Dory sites in recent months, and a lot of work has happened around keeping the brands healthy. On the other side, what we are seeing is there are investors, and obviously a lot of our multiple owners as well, that can invest in the bigger restaurants, the bigger brands that need 5 million, 5.5, up to 7 million. What we are finding, we need to have formats or brands that are more entry level, so we can attract the incoming franchisee that's got 1.5 million to invest, or 1.7. Because generally the investor that's got 5 or 7 million, they don't normally want to run the restaurant. Whereas the young entrepreneur, he probably can afford, let's say, 2 million at the max. So that's what we're busy with at the moment, is looking at our brand portfolio and formats so we can start attracting that early adopter franchising. So it's not easy. But the smaller formats also help us going to smaller towns as well.
Absolutely, because when it comes to building on Spur's growth trajectory in South Africa, your plan is to open up 41 new restaurants over the next year, but also getting your hands on this 60% stake in Doppio Zero has really caught some attention over the past weeks of Val. So one wonders, is acquisitive growth with franchisee already locked in more so the avenue to growth, and a more lucrative way of spending free cash right now, or not necessarily?
Okay, so we are looking at both. Obviously, our bigger portfolio of brands, which is now close to 600 restaurants with Africa, I think there is still huge opportunity to expand the existing network and the existing brands in Africa and, of course, in South Africa. So that's our priority. What the acquisition does is just add to the portfolio and also capture that day part market share that we spoke about when we got it. We don't foresee lots of acquisitions of little small chains. That's not really our strategy. Our strategy with Doppio was to complement our specialty portfolio. We are obviously looking at categories that we're not in at the moment, but our cash allocation will probably be a combination of share buybacks, perhaps some acquisition down the line once we've integrated Doppio Zero, and then a big focus around our own brands that we know well and are appealing to the market.
Okay, so bottom line, Val, what would you say are the key characteristics of a resilient business model in the restaurant business right now?
Okay, I'm busy uncovering it. I think, I think we were actually chatting with our CMO, Vuyo Hender. We were driving from a meeting on Saturday, actually, having this long conversation saying, sometimes we analyze business, and business is back to the basics, simplicity. I think the first thing is absolutely knowing your customer, understanding the changing needs of the South African consumer, and ensuring that we're responding to their needs, whether that's on price or it's on taste, on environment, where they must find our brands. And so I think that's the first thing, for us to remain closely associated with our customer and also our family club member. They are extremely valuable. You know, we've got 3 million active users, and well over 50% of the sales we do are from the family club members. So we're on a big drive to expand that and offer a lot more value around the consumer. I think the next thing is to look at supply chain. I think the supply chain is going to continue to have challenges. I don't think it's over. You know, we had the oil issue with the Ukraine war. We've got the Middle East crisis now. We've got the avian flu. I think it's going to, the ports not clearing the containers. I think we've got to brace ourselves for alternative thinking around supply chain. You know, what are the alternative products if you can't get frozen chips? What are the alternative options for consumers? And that points in the opportunity of enterprise development. You know, can we carve out 5 or 10% of our supply and actually give it to local entrepreneurs that are growing potatoes, that are growing vegetables? We're already buying some chilies, for example, from a chili grower. So I think supply chain certainly going to need attention. And then, of course, just to look at the other economic factors that are facing the country, because the consumer is going to be strapped for cash. So we've got to try and look at how do we add value to their experience. So they might come and pay a little bit more of a premium than QSR, but what are we doing to give them that safe space for their kids, that experience of dining comfortably in a safe place? So a lot around the dining experience, and many other factors that we're exploring.
Absolutely. So, given all the challenges the restaurant industry faces, Val, what's your outlook for the local restaurant industry as we now venture into 2024? And I mean, how are you rating your competitive muscle within that environment?
Yes. I, in fact, had a lovely conversation with one of our biggest multiple franchisees recently. And we were also debating, you know, what does the future look like? I've always got a lot more hope because I think of our business as trading in a country where there are millions of people with children. And I know, yes, you've got to be able to afford to come and eat out. So when I look at the economically viable South African consumers, it gives me hope that we can be there to offer them, as they move up the economic ladder, the opportunity to dine with us. So I don't want to be without hope to say there is hope in South Africa, because these families have to feed their children, feed themselves, and celebrate, more importantly. But I think we mustn't be naive. I think it is going to be tough out there, and it's probably going to get tougher before it turns, when we start realizing that we've got to get involved in our communities. We've got to help and work with government to try and resolve some of these infrastructural problems, but more importantly, try and create more job opportunities.
Absolutely. Well, Val, it's been an absolute pleasure catching up with you today. Thanks so much for having joined us on Smart Money, and we'll chat again soon.
Lovely. Thank you, Alishia. All the best for season.